Welcome to the second lecture of the model series. During this lecture, we're going to discuss points of interest. Before I'm going to begin with this lecture, I must advise you to first watch the first lecture if you didn't yet. Next to that, you should have done the homework before watching this lecture. The reason why I want you to do those things is because you're else going to do yourself a disservice by already taking a look at this lecture. I know it may sound stupid or it may sound weird, but that's just the way effective learning gets done. You follow the structure that gets provided. You don't just jump from this to this to this. No, you follow the structure that gets provided, and then eventually you will notice that the growth takes place by following that structure. So that's why I'm advising you to do those things. Before we begin with this lecture, I'm going to first give you a risk disclaimer. I am not a financial advisor. Everything that I say and share within this lecture is meant purely for educational and/or entertainment purposes only. If you want to read the full risk disclaimer and terms of services that you agreed upon when signing up, you can do so by going to the website that can be seen within the webpage. Next to that, you can go to theonesthatknow.com/terms of service and you will be able to find all of the details. So let us take a look at the schematic that was shared with you initially during the last lecture. In this schematic, we can see bullish order flow, aka a market maker buy model. We can see the sell side of the curve right here. Sell side delivery occurs into a point of interest during a time of interest, and from there on a smart money reversal occurs and the market reverses and goes higher, targeting buy side liquidity. If we anticipate higher prices, we look for the POI, the point of interest, to be reached during our TOI or time of interest, and we wait for signatures to confirm the smart money reversal. During this lecture, we're going to focus on what this blue line is and on what this point of interest is. So here's the bearish order flow example, the market maker sell model. As you can see, repricing higher occurs, buy side delivery into our point of interest during our time of interest. Boom, market reverses and it delivers lower, offering sell side delivery. Again, we're going to focus on what this blue line specifically is during this lecture. So first of all, we're going to start with something very basic, but it is important that you understand this. So take notes. Higher time frame PD array as a POI, or that means that we will utilize a PD array on a higher time frame as a point of interest. So what this could mean is the following. We could utilize higher time frame balanced price ranges, breaker blocks, mitigation blocks, and imbalances as point of interest on the lower time frames to see whether or not market maker models can unfold from them. If we take a look at a few schematics that I've created for you, I want you to do the following. I want you to take a screenshot of each schematic. I'm sorry if the watermark is on it when you're going through the video initially. Just wait because it will eventually move and then just take a better screenshot. I want you to save those screenshots somewhere and I want you to utilize them when you go into your own charts to investigate to see whether or not there's any validity behind what I'm saying. So here we can see the first schematic. As you can see, this is the schematic in which there's a CB on the left side of the curve right here that gets extended to the right. Market taps into that, boom, expands higher. That's what it looks like on a higher time frame. But what I will share with you today will open up your eyes when it comes to knowing when and where market maker models unfold on the lower time frames, because every single move has a market maker model in it. It's as simple as that. You will never find a market move that does not have a market model in it, and that shows the beauty of them. So if we zoom in on this delivery right here, on this down close candle, and the candle next to it, you can see that equal highs get created here. Market then opens with this candle, it trades lower. What do you think this looks like on the lower time frames? That delivery lower is the sell side of the curve within a lower time frame market maker buy model here. We then see that the POI, the point of interest, this old CB gets reached, this blue line. Smart money reversal takes place, and then this big up close candle occurs, which is the buy side of the curve. And that's how you can see whether or not market maker models unfold in one another. It's the fractality of the markets explained. If we take a look at the next example, we can see the breaker block example. For the breaker block, we can see that a low gets engineered after sell side delivery occurs. Here, market retraces into what? Into this CB, creates a high. That high gets utilized to send price lower once more, purging the sell side liquidity below this low. It displaces to the upside. Boom, it retraces into the breaker block, finds support there, continues higher. That's what it looks like on a higher time frame. But if we zoom in again on this delivery, on the delivery that has been annotated, we can see that equal highs closely got engineered right here between this indecisive candle and this down close candle. This down close candle delivers sell side into the breaker block. So that is the left side of the curve within that buy model. Then the market reaches that red line, that high of that breaker block. That's where your smart money reversal occurs, and that's where the low of this candle forms. And from there on, buy side delivery occurs, and the buy side of the curve gets delivered. So we have seen a few examples so far, and I'm going to keep on showing you examples until you understand this. A higher time frame retracement followed by an expansion is a lower time frame market maker model. I'm going to repeat that for you. A higher time frame retracement followed by an expansion is a lower time frame market maker model. If we take a look at the following example, we can see that there's a mitigation block. A mitigation block because there's sell side delivery. A low gets created here, market retraces, it forms a high, but doesn't create a lower low. Instead, a higher low gets created. Market expands above the high, it displaces, and from there on, you can see that a retracement occurs into that candle's high, and from there on, you can see that the market aggressively expands higher. If we zoom in again on this delivery right here, we can see that equal highs get engineered right here. That's our original consolidation. If you didn't notice that yet, then this downcast candle is the sell side of the curve within our market maker buy model. So our sell side of the curve in the falling, we can see that market expands away from the original consolidation. It retraces here, first stage of distribution or a low sell, second stage of distribution, and finally a third stage of distribution or redistribution. Then the market expands aggressively into the mitigation box high, which is annotated by this fat red line. Smart money reversal occurs right here, and boom, buy side delivery occurs, targeting the original consolidation and beyond. Now, imagine the following. Imagine knowing that you're in a higher time frame buy program. So that means on the highest possible time frame, the markets are bullish. And you go into a bit of a lower time frame. For example, let's say that you're bullish on the daily time frame and you go into the hourly time frame. Let's imagine that on the hourly time frame, you see this scenario play out or unfold. in which there is a mitigation block creation, market retraces into that during the right time of day. You see a low form, boom. How sweet is that? How sweet is it when all time frames align? How sweet is it that when you're bullish from the most highest possible time frame and you can see that bullish bias work on the lower time frames as well, because it's all connected with one another. Without these lower time frames fluctuations, that higher time frame bullish scenario, that bullish bias, will never play out. But if you know that in order for a higher time frame bullish scenario to play out, lower time frame market maker models will form, you seriously have such a big advantage. Because then it's not random anymore why the market goes up or why it retraces and then aggressively goes up again. Because you know that on the higher time frame, it's drawing to a specific price level. It's drawing to a key liquidity pool or a key PD array slash imbalance. All right, so let's take a look at another example. Here we can see a sell side delivery lower, low gets engineered, retrace, form a high. This high is your bullish breaker, but we're not paying attention to the bullish breaker now. Sell side delivery occurs again, purging the sell side liquidity below here. Market displaces above this high. It retraces into what? Into this BC, into this bullish fair value gap, and that's our PY for this scenario. So we have this bullish fair value gap on a chart. Then we see that there's relatively equal highs that got created here, or a trend line that can be drawn from this high to this high. Retail thinks, okay, a high is in, we're now gonna go lower. This is our original consolidation, sell side of the curve into what? Into that very specific price range that we're anticipating for an SMR to form in. Market reaches that bullish fair value gap, forms a low, displays to the upside, boom, there it goes. Targeting buy side liquidity above these highs right here, which is our original consolidation on a lower time frame. So let's take a look at the same scenario, but now without the whole bullish breaker stuff added to it. This is purely a BC that got formed. And this is a scenario that you will notice unfolds in very bullish markets in which there's a lot of speed and velocity behind the markets. So it's in a rush to get somewhere. What you will notice then is that there are a series of consecutive upclose candles, and between those consecutive upclose candles, there will be the creation of a BC. And if the market did not reach the high time frame objective yet, that BC will be utilized to send price higher. So the market will retrace into that over sell side of the curve on the lower time frame market maker buy model, reach that BC, and then from there on continue higher, targeting buy side liquidity and drawing towards that higher time frame objective. So let's take a look at the bearish examples. Here we're taking a look at the bearish examples, and as you can see, we're going to begin with the bearish breaker block. We can see that buy side delivery occurs right here. A high gets engineered, market forms a low inside of a BC. It then expands higher, purging the buy side liquidity before displacing below that low right there. This low then becomes your bearish breaker. So we're going to take a look at the delivery inside of here. The delivery that forms inside of this down close candle, inside of this up close candle, and inside of the next down close candle looks like the following on a lower time frame. We see an original consolidation, which gets formed here. Then the buy side of the curve unfolds into our bearish breaker price level or into the bearish breaker low. And on a lower time frame, we will see that a smart money reversal unfolds inside that bearish breaker. And from there on, we see the sell side delivery of the curve occur into the sell side liquidity engineered below the first candle that broke below the bearish breaker and lower eventually. So let's take a look at the bearish mitigation block. As you can see, the bearish mitigation block comes in the form of the following. We can see buy side delivery, a high gets formed, market creates a low inside of this BC, but it fails to create a higher high in the run afterwards. Instead, it makes a lower low. It then displaces below the mitigation block. We're going to focus on this delivery right here. Market retraces into that mitigation block here. Inside of this delivery, there's again a market maker sell model that's present. There's a expansion leg lower, displacement, retrace, continuation. And inside of that fractal, on a higher time frame, you will see those market maker models. Always. So here we can see that origin consolidation, buy side of the curve into that mitigation block low, smart money reversal, boom, there it goes, lower. So here we're going to take a look at the bearish CB scenario. This occurs when there's a lot of bearishness behind the marketplace. It's in a rush to get somewhere. And what you will see is that then when there's a series of consecutive down close candles, that a CB will form. When the market retraces into that CB and it fails to break above it, we anticipate a lower time frame market maker sell model to occur. So that means we're anticipating that this low that got created right here is going to get targeted once the CB gets reached. So that low is our original consolidation. Then the buy side of the curve unfolds into that CB's low, smart money reversal, boom, sell side of the curve. There it goes, targeting this sell side liquidity right here and eventually lower. Are you noticing how we're moving from a higher time frame fractal to a lower time frame fractal consistently? I know that some of you are probably already like, why is he sharing so many examples? Because I want you to understand this. You need to understand this. Because once you truly see it, repeat over and over again, you will see and you will know. Simple as that. And repetition is key to getting to understand this. So I know that some of you are already like, are these all the point of interest that we can utilize? Is this all there is? Of course there isn't. This is just the most basic version of a point of interest, so to say, from which a market maker model can unfold. We're now going to take a look at something more advanced, which is time-based liquidity. Time-based liquidity is a form of liquidity that is purely based on time, because I am of the opinion that liquidity pools themselves don't mean anything. Simply as that. A liquidity pool is only significant when it formed during the right point or right window of time. Simple as that. And I will explain to you what I mean by that statement. All times that I will discuss from this part on will be in New York time. And just so you note, every time that I will ever discuss within the mentorship is based on New York time. First of all, we're going to take a look at previous month liquidity. So that means if we're now in January, we're going to look at December's high and low. We're going to focus on previous day's liquidity. So that means if we are currently on Tuesday, it means that we're going to focus on Monday's high and low. We're also going to focus on previous session liquidity. So that means if we're now in the New York morning session, we're going to focus on the London session high and low. And finally, if we're currently in a new 90-minute cycle, we're going to focus on the previous 90-minute cycles, their respective highs and lows. You might think, why is this important? Because if you start to see how the market reacts of these very specific price levels during the next time windows, a whole new level of understanding will be unlocked, and you will never look at the markets from the same perspective again. So let me explain to you how we can study this. We're going to take a look at rather simple schematics. We're going to focus on PXH and PX low. X being a variable that can be replaced by whatever time window we're interested in. So if we're swing traders, we're going to focus on higher time windows, of course. We're going to look at, for example, daily highs and lows, weekly highs and lows, monthly highs and lows, yearly highs and lows, etc. So what we're looking for is when we're bearish, we're going to look for a run on buy side liquidity on the previous X high. From there on, a smart money reversal will occur within a lower time frame sell model, and we will target the PX low. If we're taking a look at the buy model, which occurs if we're bullish, we're going to look for the following scenario. We're going to look for a run on sell stops below PXL, and then we're going to look for a smart money reversal to occur here, targeting buy side liquidity above PXH. And here comes the gem for why this works and why it occurs. The reason why this works is because the market is allowed and it's programmed to move at very specific times of a day, times of week, times of month, times of year, even during specific years it's allowed to move aggressively. And in order for those aggressive moves to occur, a lot of liquidity has to be engineered during a previous time window. So that means that during a previous time window, the market will create a sentiment that, for example, a low is in. So if we're taking a look at an intraday example, it would mean that during the previous day's delivery, they will have created or engineered a lot of sell-side liquidity below that previous day low because they want to create the idea, okay, we're now very bullish. What they will do is that they will run on those stops during the next day's delivery, taking out all of those buyers that got in prematurely, purging the sell side liquidity, and then they will reverse it below that previous day low, targeting the previous day high. And it occurs so many times that you would be surprised that if you would go into your charts and you would study this by how many times it has occurred without you even noticing it. It's because you are purely focused on price, you are purely focused on price patterns, whilst you are ignoring the most important part of it all, which is the time aspect. At what time very specific things occur. And that's something that a lot of people just seem to miss. And it's understandable because you need to dig deep. You need to pay attention to details. And unfortunately, many people are lazy. It's as simple as that. So let's take a look at the previous day liquidity example. Previous day liquidity, I'm now just going to rename the X to the day. So previous day liquidity is relevant in the following sense. If we're bearish, we're looking for a run on the previous day high within a sell model. The smart money reversal will occur above the previous day high, then the sell side of the curve will unfold towards previous day low. If bullish, we're looking for a run on the previous day low. Smart money reversal will occur below there. Boom, buy side delivery towards the previous day high within a market maker buy model. Session liquidity. We're now going to take a look at the session liquidity. So that means the previous session high gets taken out. Smart money reversal will occur above there within a sell model, and then the sell side delivery occurs targeting the previous session's low. If bullish, we're going to look for a run on sell stops below the previous session low. Market maker buy model, its SMR, smart money reversal, will occur from below there. Boom, we're going to target buy side liquidity above the previous session's high. So now we're going to take a look at all the sessions that I deem to be relevant. We're going to first of all begin each day with Asia. Then we're going to focus on the London AM session, New York AM session to be precise, lunch hour, and the PM session. Each one of these sessions has different reference points that it will refer to whilst trading inside that session. And with reference points, I mean relevant liquidity pools. I will now share what liquidity pools are relevant during each session. But before I do that, I will tell you the following. Because we have these sessions on our charts every single day, we must understand that each session refers to the previous session or to the previous sessions. So that means that London refers to Asia. The AM session refers to London and Asia. The lunch session refers to the AM session, London and Asia session. The PM session refers to lunch, AM session, London and Asia. Here we can see the schematic more in depth with more details. As you can see, during the Asia session, there are no significant draws on liquidities that we can target. This doesn't mean that we can't trade Asia. It does mean, however, that Asia has very minor price runs usually. So when we know that, we need to be very nimble if we ever decide to trade Asia. During London, we can refer to the Asia high and low, and we can refer to the previous day's highs and low. During the AM session, we can refer to the London high and low, and the Asia high and low, and the previous day high and low. During lunch, we sit on our hands and we do not really try to refer to anything. However, if you do decide to trade lunch, and that you see that lunch is likely to move aggressively, then what you refer to, or what we refer to, is to all of the previous time windows. But for now, within this schematic, I have just decided to say, okay, for the model that I am teaching you, you will not often trade during lunch. It's as simple as that. There will be a few very rare instances in which you will see the model that I'm teaching you play out during lunch, but lunch trading requires a bit of a, how to say that, a bit of a different touch to the model. It doesn't mean that it doesn't work and that the price patterns that we will eventually utilize don't work during lunch. It just means that the majority of times lunch will not move as clean as if, for example, the AM or PM session would, or London to say the least. So if we're taking a look at the PM session, we can see that we refer to the lunch high and low, the AM high and low, the London high and low, the Asia high and low, the previous day high and low. And are you noticing that there's a hierarchy to the lows or highs that are relevant during the current session? Notice that the most recent session is the most important for the session that we're currently in, but the other sessions before that recent session should also be noted when it comes to what liquidity pools could be targeted. This schematic was first shared within the time PDF that I shared and released within the Ones That Know back in February of 2023. And since then, many knowers, members of the Ones That Know, have experienced light bulb moments when it comes to time and when it comes to deciphering when certain things are allowed to occur and specifically where as well. Because by looking at the markets from this perspective, it doesn't become random anymore, so to say, why the market formed a high or low there during the current session and then reversed. Because we know the reference points, we know what levels are relevant. We know what levels IPDA is locked on, and now combine this logic of previous XH, previous X low, to what was shared during the beginning part of this lecture when it comes to the higher time frame PD arrays, and trust me, a whole new world will open up for you. And as you might note, I have decided to share sessions and not speak about kill zones. The reason why I've decided to share sessions instead of kill zones is because I'm not a big fan of the use of kill zones anymore. Because I do not look at London Close as London Close kill zone. I look at it as the end of the AM session. And that's why you see 5 boxes here, whilst in the time PDF there was 6. So to summarize, you now know what points of interest we can utilize to look for smart money reversals in. You now know in what higher time frame delivery there is a lower time frame market maker model. So it means that you now know that a higher time frame retracement followed by an expansion leg or continuation leg is a lower time frame market maker model. You got introduced to the concept of time-based liquidity, and you now know the importance of PXH and PXL, and even more important to that is the following, is their relationship to higher time frame PD arrays. The moment a smart money reversal is confirmed, we target opposing arrays and liquidity pools. So that means that if we're in a market maker buy model, the moment that the smart money reversal is confirmed right here, we target buy side liquidity above all highs on the left side of the curve, and more specifically the original consolidation. As a beginner, as someone who is new or who has just started to learn about market maker models, what you can do is that you can draw a range with your Fibonacci tool from this high right here, the high of the original consolidation, to the low of the smart money reversal, measure where 50% is at, where the range midpoint is at, and try to target that. Simple as that. If you can consistently target that, you can then say, okay, let me now try and target the full market maker model. So targeting the original consolidation. You grow into that. You will not go out there after learning, after studying, after investigating, and just be able to say, okay, I'm now going to target original consolidation within every market maker model, because that requires experience that you simply do not have yet, looking at the markets from this perspective. So within a sell model, it's exactly the same, but then inverted. What we can see is the following. We see buy side of the curve into our point of interest, smart money reversal. When that's confirmed, we look to get short inside of a retracement leg, and then we target range midpoint, 50% of the range from this low to high, and eventually the original consolidation. So your homework for this lecture is the following. I want you to collect 30 plus examples in total of the market reversing if it's bearish above the PXH, and the market reversing if bullish below PXL. And now comes something that's important for you to note. Go on the time frame that you are interested in learning how to trade on. If you are interested in learning how to trade like me on the lower time frames throughout the day, so very specifically during the AM or PM session, then what you will do is that you will go into the lower time frames, meaning for example a 1 minute chart, and you will go out there and you will just study how price is reacting to the previous session's liquidity. And after we have shared the importance of time during the upcoming lectures, you will then be able to utilize 90-minute cycles as well for your studies on these time frames during these time windows. If you are interested in learning how to swing trade or hold positions for a longer period of time, you will be looking specifically at previous week's liquidity, or previous month's liquidity, or previous year's liquidity, etc. And you will study how price reacts off those liquidity pools. And note that this all occurs within one-sided institutional order flow on a higher time frame. And every run lower, if bullish, is considered manipulation, and every run higher, if bearish, above a PXH, is considered manipulation as well. The next lecture will be on time and how we can actively use it. I want to thank you for watching this lecture, and I look forward to speaking to you in the next one.